Okay, hi everyone. This is going to be the problems for Chapter 7. So we have a handful of them to go through here. Some are easier, some are harder. Let's kind of unpack these one by one on it. Let's start here with brief exercise 719. Okay, so we have a corporation. They transferred $100,000 of accounts receivable to a local bank, right? This was made without recourse. Okay, we're not going to have to track any liability there for it. It says the local bank remits 85% of the factored amount, so 85% of that 100,000, we get that up front, and the remaining 15% they kind of temporarily keep. Specifically, it says when the bank collects the receivables, it will remit to the company that retained amount minus a 3% fee of the total amount that was factored. They estimate the fair value of the 15% they kept to be worth $11,000, disregarding that 3% fee. They want to know, hey, what are the effect of the transaction on the company's assets, liabilities, and income before taxes? So essentially what we're doing here is it's a factoring arrangement, right? We're selling more or less our accounts receivable to a bank. How do we deal with this? Right? So let's kind of do the journal entry for it, and then we'll talk about how it affects, assets, liabilities, and income. Right? So as a starting point, right, we're gonna say we sold a receivable, right? So we got to get that off our books, credit accounts receivable, in this case for $100,000, right? Because we sold a receivable. The next thing, right, we're going to do debit cash, right? And what we're going to debit cash for in this case is, right, so there was a $100,000 receivable, right? They said that they're going to give 85% of that up front, right? So that must mean that $85,000 we get now, right? So we're going to do debit cash for $85,000, okay? The next thing, it's a little bit tricky, right? They say, look, we gave you 85%, we're going to keep 15%. And what specifically we're doing here is, right, we're kind of keeping this as sort of a placeholder in case, the people don't pay us. But after we collect on this receivable, Mr. Company, what we're going to do is we're going to take our fee from it and we will pay you out the difference, right? So let's kind of think about this, right? First, let's figure out the fee. Right, so they're telling us the fee is 3% of the total amount factored, right? So 3% of 100,000 is going to be $3,000, right? 100 grand times 3%. That's great. And then they say, all right, the value, right? We think, right, the value of this 15% is worth $11,000. Right? That's going to be the fair value or what they estimate on it. Right? And if you remember, right, they said, look, we're going to keep 15%. Once we collect the receivables, right, once the bank collects it, right, we're going to, of that 15%, back out our fee, right, that we calculated up here. And the difference, right, the 11 minus the 3 is going to be $8,000. We will give that to you, the $8,000, but that's later, right? In the sense that's after we collect on the receivables. The problem here is we're doing the journal entry now. We know what we got now, but if they owe us money later in theory, right, we're going to have a receivable from the factor, right? The factor is the bank of that $8,000. Okay, so if we know what we sold, right, this is what we got right here, GOT, like Game of Thrones, and this is what we gave, then we got to be, right, the difference here is a loss, right? Essentially, we're going to take a hit on this, right? So it's going to be debit loss on the sale of the receivable there, right? We're going to plug it, right? It'll end up being, in this case, $7,000, right? So if you do your total debits, right, they're going to equal the total credits, right? So this is a situation where it's factoring without recourse. A little bit of math, nothing too hard there. If it was with recourse, right, we would probably have a credit for a liability as well, because with recourse, if the underlying receivables they don't collect on, we're on the hook for that. So you can see the PowerPoint video for the journal entries if there is recourse in play, but this example was without recourse. All right, next one here. We have a company. They're giving us some information. They're saying, can you please calculate the accounts receivable turnover ratio, right, which is essentially going to be your net sales divided by your average accounts receivable, right, and that's going to be net in that case of like the allowance for doubtful accounts. And then they also want us to figure out the average collection period, right? So that guy is going to be 365 over the account receivable turnover ratio. In other words, this guy right here, when we calculate it, we're going to just carry it right over. All right, so this is going to be a plug and chug here, right? They're telling us the credit sales were $320,000. We can assume that that's going to be our net sales because there's no other facts, regarding sales. They then tell us that our accounts receivable, right? So when they say average here, what they're really getting at is that's going to be your beginning of the year plus your end of year divided by 2, right? That's your average, right? What you had in the average there. So in this case, right, the beginning of the year was 50. The end of the year was 70, right? So when you run the numbers on that, right, 50 plus 70 divided by 2, right, that's going to get you 60, right? So when you do the 320 divided by the 60, right, we're looking at 5.33 times, right? When we say times, that means how many times we've kind of collected in the period on our accounts receivable. That guy right here, right, is our accounts receivable turnover ratio and ends up becoming our denominator over here, right, 5.33. So if you do 365 divided by 5.33, that gives us 68 days, right? So what that means is, hey, on average, we collect our receivables roughly 5 times a period. And each time we collect our receivables from the day we make the sale until when we collect it, it's 68 days, okay? Let's look here at exercise 7.2, right? They're giving us some information. They're saying, can you please tell us the correct amount of cash in cash equivalents, right? So we said that it's going to be cash, right? It's the green stuff. And cash equivalents are essentially those like highly liquid assets. In other words, they're investments that from the original purchase date, they will mature within 90 days, right? An original maturity of 90 days on it. So if we run through these, right, what meets this criteria, right? Well, cash in the bank, right? That's cash. U.S. Treasury bills that mature within 60 days, right? Well, that's going to be, and it looks like they purchased on, 11/30 there. We're at 12/31, right? That's going to meet the idea there. Cash on hand, that counts. U.S. Treasury bills that mature in 6 months that were purchased on 11/30, right? They don't have an original maturity of 90 days, right? So or 3 months. So this one, we're not going to count. And then the undeposited customer checks, yeah, we could cash that in right now, right? 1840. When you run the numbers on all the check marks, right, it's going to end up being $30,690, right? That's our cash and our cash equivalents. This guy right here, it's not cash, but what we would do with it is essentially list it out as a current asset within our sort of investment section on the balance sheet. All right, next up, right, we're looking at some sales here, and they're using the gross method and the net method, right? So what's going on, right? Let's read this, right? We have a manufacturer of air conditioners. They sell 100 units on November 17th. Right? And then the units have a list price of $600 each. They were given a 30% trade discount. The sales terms were 210 net 30. Okay. So what we're going to do here, let's kind of map this out. They give us two different scenarios here, right? Scenario 1, they collect on November 26th. Scenario 2, they collect on December 15th. So a lot of information, right? As a starting point, let's just figure out what the gross sales were, right? So they sold 100 units, and it says the sales price was $600 each, right? So if we do 100 times, right, that's going to be kind of the total amount, right? If everything was perfect. But they tell us, right, there's a trade discount, right? That is like a coupon that we're going to get up front, right? So if there's $60,000, right, and you have a 30% off coupon, right, you're only going to pay 70% of that amount, right? So 60 times 70, right? The idea with this is the sale, when we run the numbers, right, it ends up being 42,000. The 100 we sold times $600 each, we got a 30% off coupon, which means we only pay 70%, right? So that's going to be the magic number, the starting point here, $42,000. Let's look at scenario 1, right? And what they want us to do here is essentially, right, we're going to have the sale on 11/17, right? That's when we sell it. And then, so I'm just going to put sale here on account, and then we collect on 11/26, right? Collect, that's great. The thing here that's important, right? This is within the window, right? The discount window, right? This 210 net 30, right? Hey, if you pay us within 10 days, we'll give you a 2% discount, right? So we're within that window. In scenario 1, we get it. How do we deal with this in scenario 1 under the gross method and the net method, right? So let's look at this for each one. So for the gross method on 11/17, what's the journal entry, right? Well, essentially, right, the gross method is going to be for the entire amount, right? We're going to do debit accounts receivable for 42,000. We're going to do credit revenue, right, sales revenue for 42,000, right? Gross is always the biggest amount, right? We're going to just do the total amount up there. On the back end, right, whenever we collect on this guy, right, on 11/26, right, what's our journal entry there under the gross method, right? Well, it was in the window, right? So what that means is they get the 2% discount. So we're going to do debit cash, right? And how we figure this out is, right, it's 42 they owe us, but they get a 2% discount, right? So if they get 2% off, that really means they only pay us 98% of what they owe, right? So that's going to be 41,160. Okay, so that's the cash we got. We got to get the receivable off here, right? The account receivable at face, right, for 42,000. And the difference here, right, to plug it, and you could calculate it this way if you wanted to do it, right, is the discount. Right, the 2%, right? So if you did 42,000 times 2%, right, the discount they got was $840 because they paid within the window. Okay, that was the gross method. Let's look at the net method. Right, and the net method tends to be more common what people use. Right, so we're going to have our two dates here. What's the journal entry on the day of sale? Right, it's within the window. Well, the net method, right, what they're going to do is they're going to assume that we get that discount, right? So they're going to do debit account receivable, right? And what they're going to do it for is essentially the 41,160, right? What we calculated up here. When we account for the sale under the net method, we say, hey, this is a good customer. We assume they're going to pay within the window, right? So debit account receivable, 4160, credit revenue, right? 4160. On the flip side, right, whenever we actually collect and it's within the window, it's pretty easy, right? We just tee it up, then we get rid of it, right? Debit cash for what they pay us, the 41,160, right? Credit account receivable, 41,160. So the upshot of this is when it's within the window, right, which most of the time it is, right, it's easier to do the net method, right? You just tee it up, you get rid of it. It's uglier, a little bit harder, nothing too hard for the gross method, okay? Now, let's look at scenario 2, right? We're going to have the gross method, not GRPSS, right? And we're going to have the net method. Okay, so, and what's the setup here, right? Because it's a different scenario. So the sale, right, is still on 11/17. That's great. But they're telling us here they only collect on November 15th. right? So this is outside the window, right? It's 210. It's not 2 forever, right? If you pay within the first 10 days, we give it to you. Here it's like a month later, right? You're not in that 10-day window. How do we account for this, right? Well, the gross method, right? If we're going to start with that, it's going to be the same, right? On November 17th, right? So I'll just write it out just to, right? So we're going to do, that one I'll make blue. This one I'll make yellow, right? And then we have 12, 15, and maybe I'll change it from blue just to signify it's outside the window. Right, so here I said it's going to be the same, right? You're going to do debit account receivable for 42,000, right? It's the gross, it's, you know, big guy, it's always the biggest. Credit revenue for 42,000. Then when they pay us outside of the window, right? They don't get any discount, anything like that. They're going to just pay us the full amount, right? Debit 42,000, credit account receivable 42,000. Okay? Let's look at the net method, right? Well, the initial entry is still going to be the same, right? Debit AR 41 160, credit revenue 41 160. We assume up front that they're going to pay us in the window. The problem here is when they actually do pay us, right, it's outside the window, right? So when they pay us, they're like, we're not getting a discount. Here you go, right? Here's the 42,000, the entire amount, right? Then what you do is you're going to get the receivable off the books, right? You got to get this guy off the books because they paid us back. And the difference here, right, the remaining difference is going to be a discount that you forfeited, right? Basically, you know, we need to, you know, tee this up, true this account up, right, for the difference, right? So the 42 minus there, the 840. So what's the upshot of this, right? Well, when they pay outside the window, right, it's easier to do the gross method. And it's a little bit harder to do the net method, right? There's a little bit of setups there. So inside the window, smiley, frowny. Outside the window, or I'm sorry, inside the window, frowny, smiley. I'm getting my emojis wrong here. Outside the window, smiley, frowny. So you can see it reverses there. All right, let's look at the next one here, right? During the year, in the first year of operations, they recorded sales, a business of 10.6 in sales. That's great, right? They say, look, you know, we expect, right, 8% of these sales, of all of our sales, are going to be returned, right? So our total estimate here, the 10.6 million times 8, right? We expect in total from this, there's going to be 848,000 of total estimated returns. Then the facts tell us that, hey, during the year, right, there were 720,000 of actual returns, right? We made some sales during the year, but in that window, right, maybe people came in a day later and returned it, right? So we got to back out 720 here of actual returns during year one, right? The difference on those, right, is going to be 128,000, right? So these are essentially our remaining estimated returns, right? When we made this estimate, right, yes, some of that could happen in the current year, but some of that may happen in the later year. How do we deal with this, right? So essentially what we're going to have to do at the end of the year is make a journal entry for this, right? Debit sales returns 128, credit refund liability, right? We're basically sitting on this money that isn't ours, right? 128, 128. We expect these returns to happen. And likewise, right, whenever we made these sales, right, you do like debit, account receivable, credit revenue. We also got the inventory off the books, right? We did debit, cost of goods sold, credit inventory. Now what we have to do, because we have this sort of estimated amount, right, we have to reverse some of that with a placeholder account, right? So they're telling us here that inventory cost of goods sold is 60% of sales, right? So if, the sales here, right, were 128, right, we're going to multiply that times 60%, right? We're looking at 7680, right? So we're going to do a debit to inventory estimated returns, right? And then we're going to do a credit to cost of goods sold for the same amount. And again, why are we doing this? When we sold the inventory, we got it off the books. Now we expect, in theory, right, an estimate that some of that we're going to get back, right? So we're going to do debit inventory for what we expect our estimated returns to be. This is kind of a placeholder account, right? When they actually do return it, we'll flip this out and then debit sort of true inventory. But we do want to get that cost of goods sold off the books, right, for the 60% of the remaining estimated returns. Okay, so we're kind of like, we did something up here that involved inventory and cost of goods sold. Because we expect some of it to be returned, for that portion, we got to undo what we did up there. Okay. All right, let's look here at 713. They're giving us some facts, right? We have a company, they use the allowance method, right? We know that's GAAP, that's great. It's adjusted based on bad debt expense as a percentage of credit sales, right? So we said for bad debt expense, right, you kind of have two options, right? The percentage of credit sales where it's simple, and that will tell you your bad debt expense. And then we have sort of the aging method, where that normally tells you the ending balance you need in your allowance for doubtful accounts. They're telling us here, right, for the year, our net credit sales were 4.5 million. We expect we're not going to collect on 1.5% of them. There were no previously write-offs, and the allowance for doubtful accounts had a credit balance of 42,000 at the beginning of 2024. So they're giving us the beginning balance and an ending balance here. All right, this is a lot of information. Let's start here with just the T account for the allowance for doubtful accounts, right? We said this is a contra account to accounts receivable, right? So you're going to have your beginning balance on here. You're going to have your bad debt expense, right? Which is kind of like step one, in the sense you do debit, bad debt expense, credit the ADA, right? This account, right? Because you're crediting it here, it's on the right side of the T account. Then you have any write-offs over here on the left, right? That's step two, right? Normally that's for like prior year sales on there, right? If you're doing it in the current year, but this is going to be debit allowance for doubtful accounts, credit the account receivable. That's the write-off, right? Because you're writing off or getting rid of that account receivable. That's going to get you your ending allowance for doubtful accounts, assuming everything ends on a credit balance, right? So they're telling us here, right, we had 42,000 at the beginning of the year. Check. We had 40,000 at the end of the year. Check. Our bad debt expense, we use the percentage of credit sales. So what we're going to do is the 4.5 million times 1.5%, right? That's going to get us 67.5, right? 4.5 times 1.5. What they're then saying is, right, so that got us 1, right? What is bad debt expense? 67.5. Assume there's no other adjustments. Determine the amount of accounts receivable written off, right? So what we can now do is, right, that becomes our X. 42 plus 67.5 minus X gives you 40. Simple algebra, right? When you run the numbers on that, right, you reverse it and solve for X, you're going to land at write-offs of 69.5, right? That's going to be the X, 69.5. Okay. And then it says if the company uses the direct write-off method, right? Well, that's not GAAP. You would use that for like your tax return. The setup with that would be you just take the expense, you know, in the year it happens, right? So it would be the 69.5 for the actual write-off when they convey to us they're not going to pay. Okay. Let's look at 714. Right, we have another setup here. It says they categorize their account receivables into 3 aging groups. Okay, so looks like they must be using that aging method here. They tell us before recording any adjustments, their allowance for doubtful accounts. Right, they're telling us it has a debit balance of 45. You know, it's possible, right? That's what they're telling us here. Normally, you're going to see the beginning balance on the right. But what we need to do is they're using the aging method, right? So we need to kind of put this in the buckets, right? So we have kind of our group, right? So it'll be like not yet due, right? So we're taking all our receivables, right? We're kind of putting them in buckets, right? Some of them are not yet due. Some of them have been 1 to 45 days past due, right? It's like your homework's past due. And then some of them have been greater than 45 days past due. Right, we basically look at all our account receivables and we put them in the buckets here, right? So it says accounts not yet due, 180,000, estimated percentage of uncollectability, 10%, right? So we got 180,000, and then for these guys, 25 and 10, right? 25,000, 10,000. Then they tell us the percentage or the likelihood we're not going to collect on it, right? This guy, right? These ones, we think it's 10% chance, right? We're not going to collect on it. These ones, 20% chance, right? These ones, 30% chance. The percentage is getting bigger, right? Because like the more time that it's overdue, right? Like if you had somebody who hasn't paid you and it's been 1 day, it's still pretty good odds they're going to pay you. If it's somebody who needs to pay you and it's been like 2 years, you might as well kiss that goodbye, right? They're not going to pay you. So the odds of uncollectability are higher. So what we do here is, right, we're just going to cross multiply, right? We're going to do that for each of them. So we go to the right first, as it were, right? So it'll be 180 times 10%, and then we can just drag that formula down, right? When we sum these amounts, right, we're looking at 18,500. Oh, this should be $10,000. Sorry about that. We're looking at $26,000. Okay. What ends up happening here is, right, we go to the right, then we go down. This becomes the ending balance over here, what it should be, right? So we have our beginning, our ending, and then what that ends up being, right? If we know our beginning, our ending, the aging method, right? The X is over here, right? So it's going to be 45 plus X gives you 26, right? So it's, when you run the numbers on it, right, to get it to work, and remember, this is a contra account, so it's going to be plus minus for kind of the positive numbers. That X ends up becoming 71,000, right? Like 45 minus 71 on here, that will get you to the 26 for it. Right? Again, you got to think of it like this, right? Like negative 45 plus positive 71 gets you to the 26. Okay, and that's ends up being our bad debt expense, right? Step 1, right? So we would do debit bad debt expense, credit the allowance for doubtful accounts. So that's the setup here. The first one, we looked at the percentage of credit sales, right? We said when you do this, most of the time you're solving directly for the bad debt expense, and the X can either be the ending balance or the write-offs, right? When you're doing the aging method, you're solving for, I'm sorry, not the bad debt expense, the ending balance, and then the X can end up being, either the write-offs or the bad debt expense. It's basically just like either of these two routes, they give you what you're figuring out. In the percentage of credit sales, you're figuring out bad debt expense. In the aging method, you're figuring out the ending balance in that allowance for doubtful accounts. All right, let's look at another problem here. Okay, so it says on June 30th, we had a company that sold some merchandise to a customer for $30,000, right? So we have 630, right? There must be a note receivable, right? They agreed to accept a 6% note requiring payment of interest and principal on March 31st, 2025, right? So that's 6/30/24. And then, hey, all the way over here on March 31st, 2025, right, they're going to pay us back, right? That's when we're going to get the money plus the interest. Okay, and then they say, oh, by the way, right, this happens to coincide with our fiscal year end, right, the end of the year for there. How do we kind of account and deal with this situation, right? Well, they're saying, can you please prepare the journal entries to 1, record the sale of the merchandise. Let's not worry about cost of goods sold there. 2, to do the AJE, right, for any interest we got to accrue for that period. And then 3, right, on the back end, whenever we actually get paid on this thing, right? So let's unpack these one by one, right? We got 6/30/24. That's going to be the yellow guy, right? So, hey, we sold some goods. There's a note they're going to pay us later. Debit, note receivable, credit, revenue, right? $30,000. We're not going to worry about the cost of goods sold journal entry here. Our focus is on the notes. check, right? Call it a day on that. Now, right, we're at the end of 2024. Right, the blue guy, right? If you think about it, right, there have been, right, 6 months that have passed, right, from here to here, right? So 6 months. We need to accrue the interest on the note for that period, right? So let me give you the journal entry and then I'll explain to you how you did it, right? So it's going to be debit, interest receivable, right? They're not giving us the interest right now. We're just accruing it. They're going to pay us later, on the green date there. And it's going to be credit, interest, revenue, right? The amount, I'll just give it to you and then I'll show you how we calculated it. $900, right? What we do here is, right, we're going to take the 30, right, the face of the note, right, the $30,000 times, in this case, the 6% times, right, 6 months have passed, right, 6 over 12. Okay, nothing too hard there. All right, let's do the green journal entry, right, 3/1/25. So we know here, right, that they're going to pay back the note and they're going to pay back the interest. So one of the first things we can do here is credit note receivable, right? We got to get that off the books, right? We teed it up, then we got to get it off the books because they're paying us that back. The next thing, right, we have to consider in this formulation is that there are 3 more months, right, from 12 to 3 of interest that we got to accrue for, right? 3 more months. So we will do, in this case, right, credit interest revenue, right? And that is going to be for $450, right? That will be 30 times 6% times 3 over 12, right? 3 for the 3 months up here, 6 for those 6 months over there, all right? Then what we do, right? We did the $450 for the interest revenue. We did the credit for the note receivable. Right now, we know that they're going to give us the cash that they owe us. Plus, we have to, in this case, when they give us the cash, we are going to get rid of the receivable up here. That should be debit, interest receivable. Not a big deal there. C versus V, right? So, right. So they're going to give us the cash, and we got to get the receivable off the book, right? Because we teed it up. Now we're going to get it off for 900. So the cash, right? One way you could do it here, right? You could sum those 3 guys to make it plug, right? That's one way you could do it. Or you could think about it, right? Whenever they ultimately owe us, right? It's the face plus the interest, right? So it's going to be the 30 grand they owe us, right? For the face of the note receivable plus the interest, right? And the interest when they actually pay us is for the entire 9-month period, right? So that way it would be 30 times 6% times 9 over 12, right? So there's a difference between the cash when they pay us versus whenever we recognize the revenue from it. Okay, so the number on that would be essentially the 1,350, right? It would be that guy 900 plus 450, right? That gets you the 31,350 on there. Okay, one more here. We have a setup here, right? It looks like we have a company and their checking account balance is 23,820, right? So they, right, it looks like they get a bank statement, right? They open that thing up. It says, look, your cash balance per the banks, we open it up. You have 23,332. We're going to just call this balance per bank when you open it up. Okay, that's the bank statement. However, right, we go to our books, right? We look at sort of the T account, the ending balance there in cash, and our books, right? Our balance per books, right? They're telling us over here, it is, let's see here. General ledger showed a checking account balance of 23,820, and then the cash receipts, the bank statement dated May 31st, 1890. Where are we getting these numbers from here? Give me a second. Let me look at this. Okay. All right. I see what's going on here. All right. Let's reverse this out, right? Because I read this. This was the reading this. So they're telling us the general ledger. So our financials are 23,820. Okay. What they're doing here normally, and I don't like that they're doing this because like I would rather have a problem where we just reconcile and show that it's the same, but they're kind of in traditional accounting, like doing things backwards. They're giving us our balance per books, and then we're going to need to kind of figure out what it should be based on the bank statement and then back into the balance per bank, right? That's what it says here. Hint, you'll need to compute the balance that would appear on the bank statement. Not a big fan of this, but we can work through it nonetheless, right? Couple things here, right? It's the end of May 2024. The first thing they're telling us is the May 31st cash receipts of 2340 that were included in the books, right, were placed in the night deposit on May 31st, and they were processed by the bank on June 1st. Okay, so what that means here is we're going to have to add to the bank statement these deposits in transit of 2340. So what's going on here? We included it over here on our books, but we didn't, the bank, if you ever go to cash a check, they don't cash it immediately, right? So we included the check here on our books. It was still processing on the bank account whenever they made this statement. So we need to, because we've increased it on the books, we need to increase it on the bank, kind of catch them up to date there. Then it says, the bank statement showed a service charge of $38, right? So we're going to have to back that out over here, right? The fee. You open up the bank statement, you don't know that you got charged this fee until you opened up the bank statement, right? And then let's see what else here. It says all checks written by the company have been processed by the bank by May 31st and were listed on the bank statement except checks totaling $18.90, right? So really what's going on here are over on our books, right, we subtracted $18.90 for checks that we had written, and we expected people to kind of cash. When the bank made the bank statement, right, they had not yet processed those checks, right? Accordingly, right, because on our books we had taken a subtraction for the $18.90, but the bank statement, right, they aren't aware of this. They didn't process it in time. We got to get it up to where it needs to be, right? So this checks outstanding, right? So that's going to be $18.90, right? That's all the facts they give us. So how do we deal with this, right? It almost seems like incomplete. Well, one of the things here are, right, first thing we're going to have to do is figure this out, right? 23,782, right? That is our correct cash, right? Like we can put a smiley face there, right? That's what it needs to be. So if that's what it needs to be, right, we know whenever we have, a corrected balance that it needs to be equal on both sides, right? 23,872. Okay? Right? Like smiley and smiley. Here's the deal, right? If we know the ending balance and we know the minus and we know the positive, if you just do, a little bit of math on that, right, you will see our balance per the bank statement should be 23,332, right? In other words, if you take the 23,332, you add the 2340, you back out the 1890, there we go, there's the smiley face, right? If this were to be tested on the exam, right, I would probably do something like tell me the corrected balance, right? Or, I would give you like one of these instances in there and say, how would we adjust this, right? There was deposits in transit. Would you increase the bank statement for that or would you decrease it? Hey, there was a non-sufficient fund check, right? Like grandma wrote us a check, right? And we had included it in our books, but the bank statement, they were like, right, NSF check, grandma, sorry, that's a bad check. So we would have to back that out over here on the books. So with that, I'm going to end the lecture here for the problems for chapter 7.